Hi there. It's time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back again with Colin Cieszynski. He's our featured guest. He's also chief market strategist at SIA Wealth Management. Let's continue our conversation, Colin, on the market sell-off and what you're seeing. You were talking just before we went to break about some pockets of the sectors of the stock market that are down the least, that are providing investors with some downside protection. They have been the defensive sectors, the likes of utilities, healthcare, consumer staples have been down the least. What about our stock market here in Canada, the S&P TSX Composite? It is also down recently. It's also down year to date, but the decline is much, much more modest than we're seeing in the U.S.
That's correct, and it's something in the nature of Canada and our markets is that when we see political or economic impact in Canada, it tends to find its way through the Canadian dollar. The currency gets hit first. And with all of the risks of tariffs impacting the Canadian economy, the Canadian has gone down quite significantly. Now, what we have in Canada, especially among the largest cap stocks that have the biggest impact on the indexes, is we have a lot that are energy and material stocks that are primarily more sensitive to changes in commodity prices than the economy. And the other group is we have a lot of large companies that have substantial operations in the United States as well. So they're a little bit insulated from the trade war in that if on one hand Canada might not do as well, but on the other hand their U.S. business might do well, or their earnings come back. So as the Canadian dollar comes down, if you think of a resource stock, the price of oil being equal, say, in US dollars doesn't move, but the Canadian dollar goes down, then the Canadian dollar price of oil goes up, and that offsets the decline in the market. So so we see that with oil, we see that with gold, we see that with miners. Is all else being equal, because the dollar's gone down, their stocks tend to not go down quite as much. And again, also some of the larger multinationals and some of the defensive names have also helped to hold up the Canadian market. So we didn't see the Canadian market go up as much as the U.S. in previous months, and now it's not going down as much either. Okay, let's go to gold. Gold has held its own during the period of steep market declines. It hasn't rallied a whole bunch. It hasn't broken through $3,000, as is a very common forecast among people who watch gold. But what should investors understand about the performance of gold, which is essentially traded sideways, and that's a pretty good performance in a stock market environment like we're now in? Absolutely. So this is a not uncommon pattern. And if we look here, we can see last year, the rally in March consolidated for 3 or 4 months and rallied from July to November and went sideways for a couple of months. And then we had a big rally in January, and now we're going sideways. It's what I call a staircase pattern. You have new money comes in, and then for a while it consolidates. But as you hold at each higher level, it indicates that there's still a lot of support behind it. And in the case of gold right now, we're sitting just below that big 3,000 round number, and previously it was the 2,500 round number or the 2,000 round number. And when you get around these round numbers, often markets will digest a little bit.
Do you have a forecast on gold? Are you in the $3,000 plus camp for 2025?
Well, right now it looks like we're in kind of a 2,800 to 3,000 range. But if things keep going the way they are, then it could break through and go to new highs. Okay, let's pivot to the Bank of Canada. It is going to make a rate announcement tomorrow, widely expected to cut by at least 25 basis points. There are some bank watchers who think a 50 basis point cut is possible. What do you see the bank doing and saying tomorrow? Well, it'll be interesting because it'll be wanting to support the economy without panicking, because certainly if you start going 50 basis points or more could be seen as a signal of that the Canadian economy is in big trouble. And we did see cuts late last year when the tariff threats started to really loom following the U.S. election. So in some ways they seem to have gotten ahead of this, but if they do cut by more than 25 basis points, would be indicative that that there's a substantial negative impact is already hitting on the Canadian economy. So we're keeping an eye on that going forward. Do they kind of stay the course with 25 basis points or do more. And Canadian inflation has been relatively benign to this point, so there does seem to be room for them to cut a little bit further. The one thing we also watch is the Canadian dollar. The Canadian dollar has stabilized right now, so that again suggests that the tariff impact to a certain extent has probably been priced in, which would give the Bank of Canada room to cut rates. But I will go back and remind people about 25 years ago, the Canadian dollar had gone down quite substantially, and there came a point where the Bank of Canada was not able to cut rates further, and they even had to raise rates a couple of times to defend the dollar. We're not at that point yet, so they're still at a point where we can cut rates, but if we did see another substantial down leg for the dollar, that could become an issue.
That's Colin Cieszynski helping us out in a big, big way to